Hello guys, Spencer here. Today we'll be going over one of my more favorite type models to use in the financial world, and that's the CAPM model. CAPM is the capital asset pricing model, and it is extremely basic. It's essentially an ordinary least squares to get your beta, and you plug in your other terms to get your expected return. Now, I like this model because it's very easy to do, it's very easy to explain to others, and as most basic form, it's very easy to just stress test your model with other models that you might have. Now, there are some assumptions that need to be taken into consideration if you were to use this particular CAPM model. So, one of these assumptions is that the market is efficient. You believe that the market is 100% of the time correct. Whatever price a given company is being traded at, that is how much that price is worth today. The other assumption is that the people who are actually buying into the stock market, they are risk averse people, and also they are rational people. Now, the CAPM model does not really take into consideration of the fluctuation or the volatility of the risk-free rate. If we look in the past 5 years or so, the 10-year rate was around 3%. Now it's 0.8%. So just taking into that consideration that volatility on that particular risk-free instrument is not very accurate, and that will definitely have a great effect on your expected return for a given company. If you haven't already, make sure you hit that like button for this video so that others might see this video and click on it as well. It really helps out the growth of this channel. Also, make sure you hit that subscribe button with the notifications on, because I always do some really incredible videos related to data science and the financial industry. This type of channel is largely related to how you apply the theoretical realm to everyday life. So without further ado, let's get back to the video. Now, if you're interested in the financial realm, I also did another video related to the efficient frontier using Monte Carlo simulations to get its weights. Very interesting video. If you like that sort of stuff, please make sure you hit this notification thing that just pops up if you're interested in that stuff. The capital assets pricing model, or the CAPM, this is the equation. It's essentially like a least squares equation, almost like y is equal to mx plus b. But our given components that we have with our given CAPM model is to essentially predict our expected return of our asset. So in terms of our asset will be a stock or a company. The RF is our risk-free rate. That is largely related to T-bills, treasury bills, or bonds, 10-year, 5-year, 1-year, whatever. You got your beta term, which we will find out. It's essentially your slope between your expected returns on a daily average, or on a daily basis or a monthly basis. It really depends on how you want to tweak your model. We got your expected return of your market, and this is largely just like your historical data or historical returns from your market. In this case, it will be the S&P 500. And then we have a risk-free return metric right there. So this is essentially the capital asset pricing model. And in this video, we're going to go further into depth on how to apply this with our everyday life. So let's run this part. This is just loading in models and modules, and this is a function that I just created to just load in the data. I'll be using between 2015 to 2020, so 5 years worth of data, and right now it's November 8th, so I just did November 8th to start it off, and we'll be returning a data frame over here. So this one right here is the treasuries that I loaded over here. So you can check out this website and you can play around with what that looks like and what type of time frame you want to work with. And this is related to the 10-year treasury, and you can just download it off that website. So I'm just reading in the CSV, which I already downloaded, and this is what it looks like. We have our dates. I did it in this case, it was a daily period, so day to day. Notice that I have some as NAs, if you want to call it that. I'll be cleaning this up after this cell, but the DGS10 is basically the 10-year rate for a given treasury. So we'll be changing this name for more clairvoyance. So over here, notice that I just created a for loop and then going through these periods. So if there's no data for that given day, I assume that the previous day it just bleeds on over to the next day, which does not have a given rate to it. So that is one assumption that I did for my given data set, so we don't have as sparse a data to work with. And this is what the T rate looks like. So notice that at the second observation, we have 2.32, which is the previous one at 1. So I just got the previous cell and brought it down. Cool. So using my previous function up here, historical data, I am now scraping data from Yahoo Finance for the adjusted closing data that I'll be using. In this case, I'll be using Wells Fargo, and I'll be comparing that with the GSPC, which is essentially the S&P 500 ticker symbol. And this is the data I'll be working with over here. So there's some cleaning up that I need to do. And for this part right here, I notice that this is a warning sign, but I'm essentially shifting the date, the row index, into the dates column. And I'll be using this to compare with my other data set related to the T rates over here. So I can be merging the T rates, the treasury rates, and the day-to-day, I guess, ticker price for a given company. And that is what the data looks over here. So let's merge this. I am just doing a like a typical merge, use like an inner join. I'm using the dates aspect to combine the attributes together, and then we just append values. So on a given date, we have the rate of return, we got the Wells Fargo adjusted closing price, and we have the S&P closing price, and we do that all the way down to today, 11-5, which is a Friday, I think. Yeah, Friday. All right, and then after here, I just calculated the daily returns. There's a really neat function, percentage change. And I am using many of the functions I did in my previous video with the Monte Carlo simulation. So please make sure to check that out if this stuff is slightly confusing. But I have the percentage change from the day-to-day basis. And since we have an NA for our very first observation, since we calculated a percentage change, we just took that out over for this next cell over here. So after we calculated our percentage changes over here, we calculate the excess return. So what do I mean by excess return? This is essentially calculating your expected return for your given company. You subtract that from your risk-free rate, and that is your excess return. So it's basically your spread from your risk-free from your risky asset. And I just created an additional two columns over here, two features, which is it has included the 10-year rate related to our overall return. And notice that I divided by 100 because it is a percent. This is a percent, so just calculated it to a decimal, and we have the same units. Cool. And then this is like the only thing you really need to run to get your beta. It's this very simple ordinary least squares type value to get your given beta, which is your coefficient, so 1.13 for that given result. Also note that I did a video on linear regression, so make sure you check that out. I'll go more in depth on as to what all these other statistics mean, but for this particular video, we will just be focusing on the coefficient, and that is essentially our beta term right here. So using this beta, we can calculate our expected return, and in this case, what we expect from Wells Fargo, if we were to buy into it right now, we can expect like a 16% rate of return, or expected rate of return, using all of our other metrics. We just utilize the equation, the CAPM formula, to generate this expected return. So notice that we have the average risk-free, which is essentially just the average of all of our 10-year rates. I just average that, and then we get our beta, which we calculated in our ordinary least squares up here, and then we get the risk, the risk of our expected returns of our market, and we subtract that from our average risk-free rate, and that is the equation up over here. That's pretty much all it is right there. But let's actually compare this value to what we have on like a Yahoo Finance or a financial modeling prep. And notice that it's going to be slightly different. Now notice that their beta is 1.09 over here for the Wells Fargo under the Yahoo Finance, and we have a beta over here of 1.068 if we were to look at the financial modeling prep. So the betas across different, I guess, users or people who generated these numbers are slightly different because we essentially just use either a different time frame or we use a different type of a metric for our y tilde x, for our ordinary least squares, to calculate the coefficient. So you can easily use the daily returns and not the excess returns in order to calculate it. And I calculated this overall data on a daily basis, whereas the financial modeling preps or the Yahoo Finance folks, they use a month-to-month basis. So let's take a look at the month-to-month. So I essentially do the exact same thing, right? I went back to that website for getting the 10-year data, which is over here. Yeah, go with this website, get in your data for your treasury rates, and you can just download that as a CSV file. And once you download that as a CSV file over here, you can just read it in and then do the exact same thing what I did earlier. You can just fill in the sparse data with its previous values, and then you can go on and do the exact same thing, but I just use a different function when I'm reading in the monthly data. So in this case, we're going to be doing the exact same thing, but on a month-to-month basis. So let's run this over here. We concatenate everything, reset the index, and this is what our data looks like related to our ticker symbols. And so we have the adjusted closing average across the entire month-to-month period. So this is just an average of the month-to-month. And we have the S&P 500, and we have the Wells Fargo. So let's do the exact same thing when we are going to get our percentage returns, daily returns in this case, and merge the data sets. And then this is what it looks like that we will be working with. So this is a percentage change and for our daily returns, and we have our DGS10, which is our 10-year rates. And then calculate the excess returns. We have an additional 2 columns. We have essentially the daily returns. You subtract that from your 10-year rates and divide that by 100. Note that you don't necessarily have to use a 10-year rate. You could easily use the 6-month, the 1-month, 3-month, 1 year, 2 year, 3 years. It really just depends on how far you want to value this company in order to take the short-term or the long-term aspects when you are evaluating what your expected return should be. And then just loading in that data, I think that's a redundant cell, so we don't need that. And then do the exact same thing where we get the results. We just put the y in respect to x over here. So we have the Wells Fargo daily returns. No, I didn't do excess. I'll switch those variables real quick and you can see what that is. But we have the daily in respect to the S&P 500 over here. Let's run that, print the results. So the reason why I actually put the company as a dependent variable and the market as the independent variable is that you are essentially trying to figure out the adjustments or the volatility in relation to the actual market. So you would essentially just plug in the market values, and then as a result, you want to see how well your returns on that particular company is affected. And so if your market is the market always has a beta of 1, and if your company has, in this case, the beta of 1.0775, then this, you can think of this as a multiple. So whenever the S&P gains $1, for example, then you can expect that the Wells Fargo company, in this case, could gain $1.0775. That's just how well it fluctuates. So you can also think of it as this, if the S&P were to lose $1, then the Wells Fargo price is going to lose 1.0775. So you can see both sides of the same coin. It's just, you can think of it as just like a multiplier on its volatility. So notice that since our monthly basis was 1.775, and this is very different from what we had earlier with a beta term of 1.13. So you can always just play around with what type of beta you're working with. But in hindsight, or essentially, it is basically just evaluating risk in relation to the market. There are other ways to evaluate risk, but this is one of the most simplistic ways and most understandable ways on how to do that. Let's actually run this over here. And what we have for a month-to-month basis, instead of using daily, we have 15.5%, and compare that to the 16.25% expected rate of return for that particular given company, Wells Fargo. There's also one thing I also want to highlight that I forgot to mention, and one of the variables, the intercept, is probably one of the more important pieces when you are looking for a company in a quantitative way, because your intercept is essentially your alpha term. You might have heard what alpha is, and it's usually like thrown around, sort of like a buzzword, but it's essentially the rate of return that you are expected to get almost immediately when you are investing in this company. It's the innate value, so to say, that you are trying to get, or you are going to get. And so in this case, if you were to invest in Wells Fargo, you can expect to actually lose money. And so many of the quantitative firms, or like hedge funds or financial firms in general, they seek to maximize their alpha, because that is their given rate of return that they can immediately expect to have from a statistical basis. And notice that our beta over here, 1.05 or 1.09, and we had a beta over here as, 1.0775. So notice how closely related they are. Let's look at the Wells Fargo, 1.068, 1.0775. So it is very, very close. We can also switch what our Wells Fargo daily return is and put that as the excess return and see how well that actually changes. All you do is just do this, rerun the ordinary least squared, and our beta is, 0.9976. So you can easily play around with that, and you can adjust it to however you would want. Is very, very much subjective, and that's one of the downsides of using this particular model. I'm glad that you made it to the end of this video. If you liked it, please make sure you thumbs up this video to get this outreach going. And I hope to see you in the next one. I'm incredibly excited because I have a lot of other ideas and financial models to showcase. So I hope to see you in the next one. Enjoy the rest of your day. Thank you for watching.